the biggest and the safest IPO, in my opinion, in 2025. Medline, we're going to rank it at the end. And also in here, I'm going to give my prediction of what's going to do in the first day based on the percent I think it's going to move and how it's going to move. And I'm going to draw exactly what I think on a little whiteboard explaining my exact strategy. And I will be live too if you want to hop into live. I'm going to be live the 17th of the morning right then. But I'm going to show you at the very end of this video exactly my two trading strategies and which ones I'm going to use to actually do this IPO. I have the fast mover and slow mover. If you know what those are, then you're OG of this channel. But I'm be explaining you how I'm going to use that to my advantage here. So for Navan, I said it was the worst IPO possible. Avoid that. And then Phoenix IPO, I said it was the most underrated IPO. All in. I have not ranked an IPO take out of debt for. In the future, if we do see a SpaceX or ChatGPT or OpenAI, maybe, but we have yet to see it. Is Medline going to be it? I'm naming this the safest IPO to put these titles out. Let's see where we're going to rank it near the end of this video. Let me tell you something. Here's a comment. Insiders own around 75% of this IPO. P Insiders Mills family before it even launches publicly. The insiders is specifically Blackstone. Just keep in mind before you become exit liquidity. So this is a genuine concern, not really a hate comment, a genuine concern for us to become exit liquidity. Let me tell you why this is not right, of course. Well, of course, 10% of the company is being sold. Navan, we had 1/6 of the IPO shares being sold, okay? 10%, that's 1/10, so it's kind of close, right? But still, a lot of the shares are being locked up and can't be sold. Well, out of that 10%, 44.5% are being bought by institutionals and angel investors. Big firms that want in on this. This is one of the biggest suppliers, specifically in surgical products here. The biggest supplier, the biggest supplier. So they want in. 44% of the of these 10% is already taken up. And 5.5 also is being bought back by the parent company. It could be a PR scheme, or they generally want $250 million of the stock back because they think it's going to do well. Either way, both of it is demand, and it's going to show in the price as well. Like I said, 50% of the shares are going to be locked up already by the institutional investors and the parent company, with Blackstone and the parent company going to be owning still up to 90% of this. They're going to own 90% of this, and they cannot sell, of course, because it has that lockup date. Institutional, parent, and Blackstone has a lockup date saying they're not going to have their 90% ownership of this company tank on the first day. It could go flat, but it's not going to tank. So I really think it's one of the safest ones here. And Blackstone has been really, really, really solid. They're the largest alternative asset manager, with BlackRock probably being more popular, being the world's largest asset manager. So Blackstone's last IPO was Legions, which I really loved and did really, really well, which I ranked right under Figure in the last time we had IPOs. So they have a lot to lose, a lot more than your average retail trader. The only reason why Navan dumped is because so much was given to retail traders and it was sold off really, really fast, or people lost faith into it really, really fast. That's one of the main reasons we have here, which will not happen in this personally. For example, we have the BlackRock CEO and we have Blackstone CEO. Really hard to get confused. Largest alternative asset manager, largest asset manager. Here's what I said last time. Like I said, Legions, I ranked second. I ranked it in between Allocate, Sum, and All In because I loved it. And number one, of course, I loved Figure. I put All In my video. I did that, and then Klarna, Gemini, and Via I was all on the fence about. So Allocate Sum, I wasn't like entirely avoidable. I was on the fence for these. So as we see, the HVAC machine, which I love, HVAC companies, Legions did really, really well, and it's up around 30% since they IPO'd, and Figure's up 40% since they IPO'd, which is really, really nice here. Retail hype, I'm just going to get into it. Retail hype business model, this is the basics I use. We're going to go into the financials really extensively since this is a healthcare company. What I like about this is we don't have the AI slop. Navan just put AI on it, and we had a bunch of creators saying, oh my goodness, AI, and all the other companies. Literally, almost all the IPOs have been coming out, and the description on Robinhood have something to do with AI. It's really frustrating. But now we get an actual company that can and will reach out to real retail investors, not just people that want a quick buck. Retail hype, 8 out of 10. This is surprisingly really, really, really high for a non-AI hype or non-technology company. Sorry for the hair, I just showered. Business model, 8 out of 10. Really, really solid. I'm going to get into the business model later. But the thing is, different from other suppliers, they supply their own brand, while other suppliers, they use other brands, so their profit margins are really, really, really small. I'm talking anywhere between 0.1 and 2% profit margins, while Medline's profit margins is all the way up to 5% year over year, which is really, really good for just a supplier, if you didn't know. Institutional/angel investing. These are the people that have lockup dates, the people that want in before we can get in. The Warren Buffetts, so whoever has a lot of money say, hey, I want to get in. lots and lots of institutional interest. 10 out of 10 on my pair. Can you compare this to past IPOs? Not really, but that's why in the next section I'm going to compare it to stocks already trading on the stock markets, and you're going to be surprised in how these are going to be doing. Size of the company, $55 billion, largest of 2025. I don't think it's the largest of all time. If it was, people would be clickbaiting, but valuation-wise, very, very solid. Financials, 7 out of 10. The financials aren't really as good as you would think they are, which is really surprising to me. I was ready to put this in take out debt category, but when I look at the financials, I might not get a few ranks a little lower on my ranking at the very end of this video. Let's go over the financial comparisons right here. We're going to go over the size, PE ratio, which is price to earnings, which shows how expensive it is compared to competitors. Year-over-year growth, how did this thing do? How much money did it make? Projected growth, how much is it projected to do next year? Profit margins, how much money are they making off every dollar? And what is their debt percent compared to the size of their company? Do they have a lot of debt comparative to their company? Because as you see, when we get into size, there's a wide variety of different sizes of companies. Johnson & Johnson isn't only a distributor, which we'll see, which is going to skew their numbers, but I'll just change it around a little bit. With distribution, while these next three companies are mainly distributors here. It doesn't matter that they're pharmaceutical distributors, unlike Medline, which is mainly products, but that may skew a little bit. We have Johnson & Johnson, McKesson, Cardinal Health, and Medline, as we see in the sizes right here. PE ratio, let's see how expensive it is. This is one of the worst parts for Medline for me and caught me off guard. Johnson & Johnson, a 20 PE ratio. Basically, a fair value play has shot up in the last year, mainly because of its undervaluedness. If you look at its numbers, they're honestly amazing numbers. I used to own them, but I didn't own them enough. I eventually sold them because they were not enough growthy for me, which we'll get into. McKesson, 24.7 PE ratio, staying around there, around the average for the healthcare sector right now. Cardinal Health being a little bit above at 30 PE, okay? Medline, 44 forward PE. This is assuming they do IPO with a 55 billion instead of 50 billions, but they're mostly leading to 55 billion IPO, so it's going to be a 44 PE. The lower range, which I saw, was 37. So that is actually insane. That's Nvidia numbers, and we're not an Nvidia level growth company, which is kind of concerning, which will change my strategy with this a little bit, and will restrict me from taking out debt to go into this one. Next, we have year-over-year growth. How did this do last year? Johnson & Johnson, 6.6%. Very, very modest for the company. The small one is projected next year, 6.8 and 6. Very stable company. Doing its thing, 500 billion valuation, so it's very modest for this. 17%. This is a breakout year for them, projected 13. Cardinal Health didn't do so well, but in the stock market they did fine. Down year, 4.4%, projected 11. And Medline hitting it off with the second place for this one, 10%, and projected 15. Number one and projected. Why? Because they distribute their own stuff, and their profit margins are higher. Johnson & Johnson, we have 11% profit margin here. Why is this? I put a little asterisk on this. It's because they don't only do distribution. And they don't only do distribution. They do other stuff as well. They have their own products as well. So McKesson, these two are just major distributors, and they don't use their own brand name, which is why their profit margin is so low. Yet they have still done well in the stock market. A little foreshadowing, over 200% in the last 5 years, which is really, really good for healthcare pharmaceuticals distributors. Well, if this went wrong, there's another sample size I used where their stock is down 86%. So you can see with these razor thin profit margins that it's very, very difficult for a company, and it could go south. But Medline, we see is a 5% profit margin, which if you compare to Johnson & Johnson isn't really anything to talk about. But when you compare it to the other two distributors, it's really, really nice, which is why I can see why they're trying to hit this valuation so high. Their investment bankers are hitting this valuation at a 44 PE compared to the industry average of 25.7 right now. Well, it's like hype of the IPO community is going to overcome. Debt, 5.6, which is pretty good for a very large corporation. 3.7, 9% for Cardinal Health. It is a smaller company, 50 billion, so that is expected. Medline, 35%. Like I said, the P ratio and debt are getting up there. 35% of their market share, which is 55 billion. So do the math. 35% of 55 billion is the debt amount they have. Pretty concerning. They are technically a lot smaller than Johnson & Johnson, but as you see the sample size, a smaller company does not mean a smaller amount of debt or a larger amount of debt here. So we went over size. Johnson & Johnson, number one. P ratio. Johnson & Johnson, the winner again. Year-over-year growth, McKesson. Projected growth, finally get Medline and profit margin. This is what people are raving about. quote unquote a defensive growth stock, projected growth margins leading the way for Medline, even though Johnson Johnson. But I'm not really counting that one because they don't only do distribution, and then dead last. So if you're looking at this, you'd say, hey, Cardinals and dead last and all of these, and Johnson Johnson the best company. Well, financials are not always everything, because as we see, Cardinal has done amazing the last 5 years. As we see from the numbers, McKesson should be doing the best and is doing the best, as you see from the numbers, and is doing amazing. And you have Johnson & Johnson here at a modest, not doing much, as we see, because it's really large. It's more of like a Procter & Gamble defense play, not really much growth aspect. Even though the numbers are really, really nice, I wouldn't even mind buying this at all-time high right now. Now, here's an example on the left of a low profit margin, like 0.5, 0.1 profit margins going south because their margins are too small and they lose everything. Well, unfortunately, with Medline, this won't happen because their profit margins are above 5 compared to these two. So that's really, really nice. This thumbs up guy is right here because I know what to put. It was like a blank space. So where am I going to rank this? At first, I was like, easy take out of debt. But ran the numbers. Some of the things were concerning, like PE ratio and debt. And the fact that it doesn't have the AI hype, I can't really justify, or any like SpaceX hype, I can't really justify putting it in take out of debt. So it's going to go right next to Phoenix IPO. I do like the numbers on Phoenix IPO a lot. There wasn't a lot of retail hype or tons of institutional backing. So I think it's fair to say that both of these are probably equal. And I will get into the next part here. So why did I rank it as I did? My final thoughts. And next we're going to get into my strategies, my predictions, and my little whiteboard. Growth plus defense. So it's growth and defense. It's not like Johnson & Johnson where you just get defense. Like, the numbers are great on Johnson & Johnson, but not a lot of people, especially these young investors nowadays, are attracted by less than average returns in the stock market for a little protection shield against a recession. Not a lot of people are inspired by that, to do that, to underperform when these guys are going into Palantir, Hood stock, and making 100, 300% in a year, right? Well, if they see a little bit of growth in defense. We're not really a long-term holder, but it's really nice to see. Slow mover and fast mover, I will get into. I think we'll have to play fast mover on this one, which we'll get into the video. But I think this is going to get in, get out, because over time, I think the P ratio will catch up to it and it will eventually drop back lower to fair value, which fair value for this, I'm going to say 35 in the short term. But fair value, realistically, if you run a fair value calculation, it should be more around 30. Even if it's down the first day, it's okay. So it's okay. Why? Because it's an amazing company. But it's hurt by its valuation. So it's a little bit of like, would I really want to hold this? No, I wouldn't. If I did get allocated a lot of shares in a limit order, it would be for 1 day or 2 days. Because its valuation is really, really high, because investment bankers are trying to take advantage of the IPO hype and take advantage of being one of the largest distributors out there. No AI slop. I love no AI slop. A lot of real retail investors that have millions of dollars in the stock market will be really interested in this. Not off IPO price, not off IPO day if they're smart, because the valuation is really high, but just in general. So it will bring in a lot of different investors besides IPOs. Amazing backing. Probably one of the best backings I've seen. Half their companies being bought up by like 8 different private equity and investment organizations. And the parent company is doing amazing. Blackstone and BlackRock are probably one of the number 1 and 2 you'd want back in your company. Really, really simple. Fast mover, not slow mover. So I'll explain what this is right now, but to put it, before I show the whiteboard, a fast mover is where we get in and get out really quick, and a slow mover is if this is going to drop a little bit in the first day, it's going to be followed by a overextended sell-off, because people want to get rid of their IPOs because I think it didn't do well. Which then we did this. Which one did we do this with? We did this with Legence. It was down 5% in like the first hour, and they bought it and ended up being 16% in the first day. I think it was Legence. So I will end up going to my whiteboard here. Okay, so welcome to class, the IPO class. So I'm going to go over the fast. Let's start with the slow movers. So this is what we're not doing. Why am I saying the one we're not doing first? Because I need more viewer retention, guys. Come on. So slow mover. Pretty simple what's going to go on here. Basically, what's going to happen is all limit orders are going to go in once. This is a dark market. We can't buy. Buying pressure goes in at the very moment. Nothing happens, right? So that's when it opens up. People are selling enough to where the initial buying pressure of where everybody put their limit orders was going in. So if you don't know what a limit order is, it's basically where you can put on anything. You just put limit order because you can't market buy right at the beginning. So you just do limit order instead. It's really, really simple. And you put a limit order like 2 times or 1.5 times the price, and it works. I have other videos on that. So basically what happens is all the buying goes at the very beginning, and then there's enough selling pressure not for it to go up, and eventually it goes down because people panic, and then there's not enough buying pressure. And the slow mover strategy is basically where you just the overextended selling, you buy in because it's a good company and it's a good valuation, and it slowly creeps back up in the day. And you sell it, you make a profit. That's basically all that one is. And next you have the fast mover, which is there is enough buying pressure here, which I think this one should be, at a limit order price, because as you see, 50% of the shares are already bought, and a lot of people are going to try to put limit orders, and they're trying to get pre-IPO access. So it's going to slow it up here. And the first, 5 to 10 seconds of being open. And there might be halts as well. What a halt is, it's going to stop, right? It can be a halt up or halt down. When it stops here, if it's a halt up, you want to sell right after the halt up. And if it halts down, you waited too long and you should try to sell as soon as possible. It's going to stop and it's not going to move. The price isn't going to move, the ticker is going to move. That's because the actual brokers are trying to fill in all the buy and sell orders. And there's too many buy and sell orders and not enough liquidity, basically. So as soon as thing stops, you're like, hey, if this is good enough to screenshot, I'm going to get out as soon as the halt's over. It's going to spike up, boop, or spike down like that, and you get out. Or basically, you wait for the first sign of weakness to see the rally of buying pressure wasn't going to come out, and you sell out. With the fast mover strategy, like I said, we're doing this quick in, quick out. So like I said, it's in the dark markets, and then all of a sudden, boom, it's released on the market, and does nothing. Well, the limit order buys were already in, regular buyers, and it's still flat. Well, since all the buying pressure went in and didn't go up, you sell out here before it gradually tanks down. There's been some occasions where it's been wrong and it stayed flat. It got up a little bit, done its thing. But overall, if it's not going up in the first minute or so, it's not going to go up. Because it's IPO, right? It's based off of hype and single day hype by a niche crowd. Specifically us. So yeah, we use the fast mover strat. Get in, get out really quickly. If it doesn't do anything, you basically sell out here. This is specifically for the limit order people here. If you had pre-IPO allocations, it's going to move a lot before it enters the public market space. But then eventually it's going to be like that, and then it's going to release to the public, and then it'll do its thing. So that's basically my thoughts on this. So you have the strategy there. I don't think that was hard to understand. I've said it so many times, so it's kind of easy for me to understand, but I like it. I'll be putting a couple thousand in there because I don't have a lot of cash right now, because I bought a lot of Ethereum and Bitcoin dips, because the regular stock market is doing fine, but all the more growth aggressive sectors have been doing really bad. I've been buying some of the dips in those, so I don't have a lot of cash in hand. But hopefully this overview helped you and you got a real understanding on the financial situation and the hype situation, the backing, and the retail investors. A lot of TikTokers, influencers, YouTubers are hyping this thing up a lot, but I want to give more realistic expectations. Not like, oh my goodness, the most blown out IPO ever. There's gonna be IPOs in the future where that's gonna happen, but it's not this one. But still, this is definitely better than a lot of the past IPOs you've been getting, like Navon and Glue. So I'm glad finding something rolling around where it's actually gonna make a lot of news. I'll see you guys in the next video. Like and subscribe. And if you're still here, I'm going to be tune in for the live stream on the 17th of the morning of the 17th.